Welcome to Safe Option Strategies presentation of Working with Options Part 1. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk and you are solely responsible for any losses you may incur as a result of trading. All right, so it's if you remember from the previous class, when we went over the 4 option instruments, I made some commentary in that class that one of the challenges is that kind of the age-old notion of which comes first, the chicken or the egg. You've heard that cliche used over and over again in your life. It's tough sometimes to know whether we should first go over option chains and option definitions that involve, strike prices and expiration dates and in the money and out of the money and all that kind of stuff. Or do we first define what is a long call, what is a long put, what is a short call, what is a short put? And I've never come up with the perfect answer to that. I hope that doesn't cause you to lose any faith in this education. I've never come up with the perfect answer. So what I encourage people to do, we've chosen to first talk about the 4 option instruments. That was the previous class, whether you were with us when we did it live or whether you watched a recording of it and you're just going in order of the recordings. And now we're going to get into a lot of detail in this class and the next class, the Working with Options Part 1 and Part 2. We're going to get into a lot of detail about what strike prices are and how they work and what the significance of them are. Expiration dates. What do you need to know about expiration dates? What do you need to know about bid prices, ask prices, and so forth? It's not a bad idea for the individual who is not just doing this as a review, because a lot of students come to us with a fair amount of option trading experience, and this is just a good review for them, nothing more, nothing less. It's just a good refresher, a good reminder about how things work. Maybe there's one little tidbit of information that helps you remember something that previously you had forgotten. And I hope that's helpful, but there are some students that are, for the very first time, this is their first exposure to options. They have never traded options before and they need to know everything about options. And so keep that in mind as you go through this, and then go back after you've done this class and the next class that follows it, Working with Options Part 1, Working with Options Part 2. Whether it's for purposes of review or whether you're learning options for the first time, it's not a bad idea to then circle back around to the class that we did before this one, the 4 option instruments, and go back through that. And maybe a few things that we went over in that class will now have a little more clarity. There'll be maybe a couple more light bulb moments where you say, aha, that's what he meant when he was talking about this. So if I knew the perfect order to go through all of this with, I promise I would work towards doing that. I don't know that there's a perfect order, so we do the best we can. And now we're going to get into the option chains and some of the option definitions. So this definition of an option as it relates to stock market comes right off of a website called Investopedia. It's kind of the Wikipedia for traders. If you ever want a definition of something or want to be really clear on what the definition of something is, it's a good website to go to, Investopedia.com. An option is a contract between a buyer and a seller of an underlying security that obligates the seller to either buy or sell a stock at a certain price within a certain time frame. The buyer of the option contract has the right to buy or sell the underlying stock during the same period of time. Remember in the previous class when we said it's always good to remember, this is one of those little nuggets of information that you want to tuck away somewhere and always be able to come back to, always be able to rely on this little piece of information, that when there is a buyer, there has to be a seller. When there is a seller, there has to be a buyer. Even though your broker keeps that information anonymous, you don't know who the buyer is of the option that you're selling, and you don't know who the seller is of the option that you're buying. Your broker is not going to float those transactions in the hope that there becomes a buyer. In other words, if you put in an order to buy an option contract, you are not going to get that order all the way through the system with your broker simply hoping that eventually there will be a seller for it. Your broker is only going to match up the buy and sell orders that are there. Okay, an option contract, one option contract represents 100 shares in the underlying stock, or in some cases an exchange traded fund. The quoted price of an option is per share. So what does all that mean? When we're looking at an option chain, and we'll get to an option chain in just a moment, when we are looking at an option chain and we see a price for a given strike price and a given expiration date, that price is representative of a per share price. But anytime we buy or sell an option, we are going to be obligated or have the right to 100 shares. Now, there is such a thing as mini options. In the next class after this one, we'll talk a little bit about mini options. But for right now, keep in mind that an option contract is 100 shares. Okay? We need you to have a thorough understanding as we move forward into the different strategies that we're going to teach through this education. We need you to completely understand every single part of an option chain, because that's going to help make sense of the trades we do and the strategies we do. The first thing you need to know in the option chain is the strike price. What does strike price mean? For a call option, the strike price is where the security can be bought, while for a put option, the strike price is the price at which shares can be sold, each one until their expiration date. Strike prices are mostly used to describe stock and index options in which they are fixed in the contract. It can also be referred to as the exercise price, okay? Whatever the obligation is, whatever the right is that we have. When we buy an option, remember from the last class, when we buy an option, we have the right to do something. When we sell an option, we are obligated to do something. Whatever it is we have the right to do, whatever it is we are obligated to do, the strike price is the price that that right or obligation takes place at. Okay? That's important to know, and we'll get into a lot of that in a lot more detail in that in just a moment. The difference between the underlying security's current market price and the option strike price represents the amount of profit per share gained upon the exercise or sale of the option. This is true for options that are in the money. The maximum amount that can ever be lost on an option is the premium paid. Now, that's if you're the buyer of the option. Seller of the option has an obligation that could be a lot greater than just the credit that they took in. Let's get an option chain up and show some examples of this. So let's first talk about the option strike prices. And let me give a couple of pieces of information. Again, this is review for most of you. For some of you, this is brand new information. It's very important that you know this. When you bring up an option chain, this is what it's going to look like. And there's going to be some consistency with every single broker that you use, every website that you go to look at option chains. There will be some consistency. There will be some differences, and I've got a couple of different option chains on the same company. We're going to use Netflix through the majority of this class so that we're kind of consistent with the example. When we get right to the end of this class, you'll see some option chains from some other companies, but we're going to go with Netflix to kind of keep some consistency here. So when we look at an option chain, usually we will see calls on the left side and we will see our put options on the right side. And most often our strike prices are going to be listed right here in the middle. So for the options that expire, now I'm going to get ahead of myself a little bit and get into expiration date. If I were to expand out, if I hit the little plus sign here and expand out any one of these, this would show me all of the options that expire at the end of this week. This would show me the options that expire at the end of next week, the end of the week after there. And on this particular company's website, they actually show the exact date of expiration. These options that we would look at if we were to expand out this particular chain right here would be the options that expire on June 16th, 2017. and so on and so forth. I'm going to talk more about weekly and monthly expiring options in a minute. So let's go back to focusing on the strike price. This is the $135 strike price. If we were to buy or sell this option, doesn't matter if it's the puts, doesn't matter if it's the calls, doesn't matter if we're the buyer, or doesn't matter if we're the seller. If we were to use the 135 strike price option, if we are the buyer, we have the right to do something for $135 a share. If we are the seller, we are obligated to do something at $135 per share. Okay, think back to the previous class. Let's do a real quick little exercise right here. Think back to the previous class. Long calls. Okay, the long call option. Do you remember what your rights are on the long call option? With a long call option, we have the right to buy a stock at a certain price for a certain period of time. If we are looking at the July monthly options between now and the 21st of July 2017, if we were to buy the 140 strike price long call, that means that between now and this time, we have the right to buy shares of Netflix at $140 per share. The strike price tells us the price we have the right to buy at. If we had bought the long puts, this tells us the price we have the right to sell our stock at. If we are the seller of either one of these options, this is where we're obligated to sell stock or obligated to buy stock. Okay, that is what the strike price is. Okay, we're gonna have more conversation going forward about strike prices that are in the money and strike prices that are out of the money. Do you notice the direction these strike prices are going? When stocks go up, when we're looking at a stock chart, as stocks are going up, over on the left-hand column, or excuse me, over on the far right of a stock chart, it would say 120, 125, 120, 130, excuse me, if we're going 135, etc. If we were looking at a stock chart, that's what it would look like, and the price would be going up. On option chains, it's the opposite. They go in the reverse direction. So as a stock price is going up, our option chain, our strike prices appear to be going the other direction. Okay? I get asked all the time why that is the case, and I honestly don't know. I honestly don't know why option chains or strike prices move in the opposite direction of what everything else we look at moves in. To me, it doesn't make any sense. I also get asked from time to time, is there a website you can go to where it's the reverse of that? I've got a better answer for that question than I've had in the past. I get asked that question a lot, and a lot of times my answer has been, I don't know, or I've heard of this website, or why don't you explore that a little bit and get back. Here's my answer. Don't bother. 99.999% of people that trade have become accustomed to the option chain strike prices moving in the opposite of up and down. Get used to it. Deal with it, because everything we send out from Safe Option Strategies is going to have the option chain strike prices moving in this direction. Everything we look at from every source we pull from for the research that we do is going to have the strike prices moving in this direction. It's just one of those things you have to become accustomed to. Don't let it bother you. Okay. Now, let's talk a little bit. I've got my horizontal line in exactly the wrong spot. When I put in a new option chain, as I was redoing this class, I forgot to move my horizontal line, so it's going to mess you up. Let's talk a little bit about options that are in the money and options that are out of the money, and what it means for an option to be at the money. Okay, most websites, most broker site, most websites that you go to look at an option chain will show you a highlight of options that are in the money and not have highlighted the options that are out of the money. Okay? In this particular case, in the option chain that we're looking at right now, and I'll show you an example of another one in a minute, these options that are highlighted in yellow, these options that have this yellow background, on the call side, these are the options that are in the money. On the put side, these are the options that are in the money. Okay? Options are either in the money or out of the money. Now, on this website, they've got it highlighted in blue. You may be able to see this. You may not be able to see it quite as well, but we're looking at the same company. There's our strike prices, and notice the direction they're going in. The strike prices go down as they're going up. And notice the in the money options are highlighted in blue. In fact, you can see right here it says in the money, and they're highlighted in that shaded blue. And on the call side, there's the line between the options that are in the money and the options that are out of the money. Okay, at a glance, that's a really easy way to look at it at a glance. There's another easy way to look at it, and we're going to get to that in a minute. I'm getting ahead of myself. Okay, I wanted to just give you an example primarily of what another company's option price is. Let's talk about bid price and ask price for a minute. The bid price, the price a buyer is willing to pay for a security you are trying to sell. It is the credit you will take in on a short option. The ask price is the price a seller is willing to accept for a security you are trying to buy. It is the debit you will pay for a long option. The last price is the price most recently filled by a market maker. This is often, but not always, the approximate difference between the ask price and the bid prices for an option. So let's go back to an option chain. Now, here's another example of an option chain, and as you can see, this is shaded very light blue. There's the line between the options that are in the money and out of the money. We're going to have several slides in a row coming up here where we talk about in the money and out of the money and what the significance of that is. Notice up here at the top of our option chain, we have our bid price and our ask price, and then over here to the left, we have our last price. Okay, in a nutshell, here's what this means. The bid price is always going to be lower than the ask price. Okay, whether we're on the call side or the put side, the bid price is always going to be lower than the ask price. Okay, look at any one of these strike prices. These are the prices of the 135 strike option. The short put would currently pay us $227. The long put would cost us $258. All right. Always remember, this is another one of those things to just memorize. Bid price is always less than ask price. Here is an easy way to remember which one applies to the short option and which one applies to the long option, and then I'm going to tell you the exception to the rule. So let me first tell you what to expect, and then let me tell you the exception to the rule. If you are the buyer, doesn't matter if it's long puts, doesn't matter if it's long calls, if you are the buyer of an option, it is safe to assume that you're going to have to pay the higher price. If you are the seller, it is safe to assume that you are going to get the smaller credit. Every trade we put together from this point going forward, if you will assume that as the buyer of an option, you're going to have to buy at the ask price, and as the seller of the option, you're only going to get the bid price, that is in every case the worst case scenario, right? If you look at these two prices and say, well, I would rather buy at $23.40, but Jeffrey is telling me I'm going to have to buy at $24.40. I'd rather get a credit of $9.50, or excuse me, I'd rather get a credit of $9.85, but Jeffrey is telling me I'm only going to get a credit of $9.50. If you will assume that every single time you open an option, whether you buy or sell, that what you're going to pay or what you're going to take in as a credit is the worst case scenario, then isn't anything different that happens just better? If I look at my option chain and I say, let me clean this up a little bit again here. If I look at my option chain and I say, I want the 150 option. I want to buy 150 long puts. And I would really love to buy them for only $9.55 a share, but Jeffrey is pounding it into my head right now that if I buy an option, I'm going to have to pay the worse of these two numbers. Wouldn't it be better to buy at $9.55 than $9.95? Of course, by 40 cents a share, it would be better. But I should look at this column. If I'm the buyer of the option, I should look at my ask column and I should ask myself the question, is it still a good trade even if I have to pay this higher amount? Is it still a good trade? If I'm thinking about selling an option and the option I'm thinking about selling is the 165 strike calls, and I'm looking at my bid and ask price and I'm going to say, man, I'm taking in a credit right here. I would really love to get a credit of 390, but Jeffrey is beating it into my head right now that I'm only going to get a credit of 350. Is what I'm doing still a good trade if I can only get 350? That's the question I have to ask myself. Whether you're buying or whether you're selling, look at those two prices and think, which is more advantageous to me? And then you'll remember that what you're probably going to get or what you're probably going to have to pay is the one that is less advantageous to you. Now, let's talk for a minute about the last price. As the markets are open during the day and brokers and market makers are filling orders, you've got an order to buy something or you've got an order to sell something. A lot of times, not always, but a lot of times, the last order that got filled, and that's what this last price indicates, is the last order that got filled. A lot of times it sits pretty close to halfway between the bid and the ask price. Sometimes it's going to be closer to the bid price, sometimes it's going to be closer to the ask price, and sometimes it's going to be lower or higher than either one of them. I can't explain to you why that's the case. It makes no sense to me why it will sometimes be lower or higher than either one of them. It is more normal to see that the last price was somewhere in between the bid and the ask price. Now, I can tell you why this happens and why it's oftentimes short-lived. If the broker is filling the most recent order this much higher than the ask or the bid price, probably these are on the verge of changing. Those will probably move now. And it's more likely that you'll find these. You don't find these a whole lot, but it's more likely that you will find them during the middle of the trading day when the stock is moving big, not small movements on the stock. On a mellow, I don't know another word to call it, but on a mellow trading day, when an individual stock is not moving a real strong percentage in either direction. Let's say Netflix right now at trading currently at 152.16. Let's say that's where Netflix is currently trading. If Netflix weren't $5 different than its highest price during the day, if it wasn't trading down 3% but trading down 1/3%, probably all of these bid prices, or all of these last prices, would be in between the bid and the ask prices. When a stock is moving 2, 3, 4% in a day, you're more likely to have these anomalies where the last price seems out of whack. That's a real technical term, isn't it? Out of whack. They seem more out of whack with what the bid and the ask price is. For purposes of everything we continue to do at Safe Option Strategies, if you will remember that if you're buying, it's probably at the higher price, and if you're selling, you're probably going to get the lower price, and see if it's still a good trade. See if the trade we're putting together is still a good trade with that in mind, then you're in good shape. And then if you get filled, if you're buying and you get filled for less than the ask price, that's just better. Okay, let's talk about weekly versus monthly options. It's been 10, 11 years ago or so, the stock market introduced for the very first time weekly options. There are very few, relatively speaking, there are few companies now that do not offer weekly options. For a long time, every publicly traded company that had options, just because a company is publicly traded doesn't mean they have to have options. A very large percentage of them do, not all of them do. I would say it's far less common for a publicly traded company to not have options than it is for excuse me, let me make sure I'm saying this the correct way. It is very uncommon for a publicly traded company to not have options, but there are still some that exist. Of the companies that are publicly traded that have options available, it is really uncommon right now to not have weekly options, but there are still some big companies that don't have weekly options. A good example is Adobe. Adobe still to this day does not have weekly options available to trade. Weekly options expire every Friday. If you were to look at those dates for the year 2017, these are in every case Fridays. Now those are on our week 4, week 5, week 1, etc. options. For a long time, companies only had I'm sorry, this should say July. Let's get this accurate with what we've got on the screen. Okay. Let's make this consistent with what we have on the screen. When we look at options and we look at these weekly and monthly options, there's a couple of things to keep in mind. Okay, and I've got to change this again and say August. But this applies to any monthly option. Monthly options always, okay, remember this and drill this into your mind. This is so important, and this will save you so much confusion going forward. I still to this day have students that, and I'm not saying this to beat up on anybody, I have students that I have to remind every few months. I still have to remind them again through an email or a phone conversation that monthly options always without exception expire on the 3rd Friday of the month. And they're most often on most brokers' websites, on most option chains you look at, they're going to look like this. There will not be this WK in the middle of the description of that option. You will have a month, you will have 2 numbers, and those 2 numbers will indicate the calendar year, not the day of the month. Folks, I cannot overemphasize. I'm sorry I got these wrong on here. Let me once again make these consistent. That should say August 17. And this should say 17 right here, okay? The number which follows the month does not ever does not indicate the day of the month that option is expiring. Please remember this. Please remember that if there's a 17 or an 18 or a 19 or a 20 that follows the 3-letter month abbreviation, it never indicates what day of the month that is. This does not mean the 17th day of the month. This does not mean the 18th day of the month. This does not mean the 19th day of the month. It means 2017, 2018, and 2019. It indicates the calendar year, not the day of the month. When we have the 3-letter month abbreviation followed by something that says week 4, week 5, week 1, week 2, etc., 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 etc. When we have that week 1, week 2, week 4, week 5 in there, that means the 4th Friday of the month of June. And do I have to point out that if this is June 17 and this is July 17, that all of these are in the calendar year 2017. I really don't have to, I shouldn't have to point that out, right? But folks, listen, the reason I'm doing this, and I don't say this to pick on them, everybody is different. Some of our minds wrap around certain things faster and easier than other things. And it's not a question of smart or dumb. It's not a question of fast or slow. It simply is some people wrap their minds around things faster than other people. Get your mind wrapped around this, please. For my sanity. No, I'm just kidding. Get your mind wrapped around this. June 17 calls expire on the third Friday of June, and they are the monthly options. June week 4 options expire on the fourth Friday of the month, and a lot of times that actual day will be out here. On the monthly options, that day will sometimes not be out here. Now, it's important for me to point out at this point in time that there are a couple of companies, and this, I hate this, I wish they would not do this. This is where it can get confusing. Sometimes when you look at another company's website, they should still have the monthly options listed. In this case, June 2017 monthly. If this did not say the 16th of June, should you be able to look at this and figure out that this is the third Friday of June? The answer, I'll give you the answer. I'm going to give it away. Yes, you should. If it says monthly, anywhere along here, if it says monthly, you should automatically know, you should know that that is the third Friday of the month. Now, this is what sometimes gets a little bit confusing, and I wish companies would not do this. There's only a couple of companies that I know of that do this. I don't use their option chains very often. I do sometimes. Week 1 and week 2 will always, without exception, indicate the first Friday of the month and the second Friday of the month. But this particular company, instead of saying that this is the week 4 option, they're indicating that this is the third weekly option. It's not the monthly option, it's the third weekly option. And so instead of saying week 4, they're saying week 3. This is very misleading. And I wish this, I've written to this company. I know some people I actually know some people personally at this company. And I've said to them, you guys have got to change this. You're one of a couple of outliers out there that are confusing everybody, because this is actually the week 4 option, not the week 3 option. The week 3 option will always, without exception, be the third Friday of the month. On a rare occasion, when there is a major U.S. holiday on the third Friday of the month, option expiration for the monthly options will be the Thursday before. That's easy to remember, right? On the rare occasion, if the 4th of July holiday, if Christmas or New Year came on a Friday, and New Year's Day can never be the third Friday of the month, right? I don't think Christmas can ever be the third Friday of the month. So we're really only talking like Veterans Day. I think Good Friday occasionally falls on the third Friday of the month. I mean, there are a few, one or two instances where there could be a major holiday on the third Friday of the month, and those options, those monthly options, would expire on the Thursday before that. That's easy to remember, and we'll give you a heads up when those are coming up. But please don't get confused by the expiration dates when we're dealing with weekly and monthly options. Okay? Here's another way to illustrate the difference right here. This is the same date. This is what I had up on the screen previously, but this is the same date. June 23rd, 2017. This broker says it's the week 4 options. This broker says it's week 3. How can that be the case when it's the same date? Even that is not overly, I mean, it's confusing, but you can make sense out of that if you will just remember that the monthly options will always be the ones that expire on the third Friday, and that occasionally this just means, in this case, this means the third weekly option, because we don't, even though they always expire on a Friday, we don't refer to the monthly options as a weekly option. They're referred to as the monthly option. Okay, I've said enough about that. This is another one of those things that I'm trying to pound it into your head. I don't want you to ever forget this. See, these week 1 and week 2 ones are consistent, but then they throw the monthly in there, and instead of going to week 4, these guys say the third weekly option. These guys go to the week 4 option. Okay. Another thing to remember about weekly and monthly options is that oftentimes weekly options have strike prices that are closer together. Notice how there's $1 difference in strike prices on these weekly options, but on the monthly options, the strike prices are $5 apart. That is common. That is common, that with weekly options, you will find strike prices closer together. Now that changes a little bit when you get into lower price stocks. When you get into lower price stocks where the monthly options are $1 apart or 50 cents apart, then oftentimes the weekly options will match up. But when you get into higher price companies like a Netflix, an Amazon, Disney, these stocks that trade at 100, $200, $300, $500 a share, Tesla at $300 a share, Priceline over $1,000 a share, you're going to have a bigger difference between the strike prices on the monthly options, and you'll find closer together strike prices on the weekly options. Also, you oftentimes find that the weekly options cost a little bit more than the monthly options relative to the amount of time you're paying for. We're going to make more sense of that when we teach some strategies, but bear in mind, because of the volatility, the implied volatility is sometimes a little bit higher in the weekly versus the monthly options. Okay, sorry, I freehand draw on this, forgetting sometimes that I've got these nice, neat looking circles that are going to be coming in. I apologize for that. Okay. Intrinsic value. Now, here's the next thing we need to talk about. Intrinsic versus extrinsic value. The price of an option, bid price, ask price, last price, it doesn't matter. The price of an option is made up of two things. There are two things that go in to an option price: intrinsic and extrinsic value. Okay? Only if an option is in the money does it have... Oh, Joseph asked a really good question. Let me answer this question really quickly. And this is great. This is a perfect question. If the holiday falls on a Friday, on the weekly options, does it expire on the Thursday just like the monthly? Yes, that's a great point of clarification. I was focused so much on the monthly options that I didn't think to mention that, and thank you for bringing that up, Joseph. On weekly options, which are more likely to find some Friday holidays, some major holidays where the market is closed, if the market is closed on a Friday, whatever option was scheduled to expire that Friday, it will expire on Thursday instead. It will never go into the next week. Okay, thank you for that clarification. All right, intrinsic value. Only in the money options have intrinsic value. For call options, the underlying stock's price needs to be greater than the strike price. For put options, the underlying stock's price must be less than the strike price. If these conditions are not met, the intrinsic value is expressed as 0. Okay? Extrinsic value, oftentimes known as time value. Extrinsic value is any premium in excess of intrinsic value. Now, I want to give a further definition of this, and I need a little bit of blank canvas. So I'm going to, let's say, here's a good way. I'm going to freehand this, but here's a good way I can explain it. Let's say a stock is currently trading for, well, let's do it this way. Let's say a stock is trading for $152 a share. That's close to where Netflix is, and that's the example we've been using. And let's say we have a call option right now that is the 150 strike price. Okay, this is our long call at a 150 strike price, but the stock is currently trading at 152 per share. This option right here, this long call option, is going to be priced, let's say, at $3.60 per share. And I'm going to illustrate this more on some other screens, but I really want to make sure you're clear on this. This $3.60 per share is made up of intrinsic and extrinsic value. The intrinsic value will always be equal to the difference between these two prices. The difference between where the stock is trading and the strike price is going to be the intrinsic value. In this case, that's really easy. It's $2 per share is the intrinsic value. That's, and I like to refer to it sometimes as the real value of the option, the actual real value. So of this $3.60 right here, a little more than half of it, $2 is made up of intrinsic value. I'm just trying to fill this in for you. Okay, this is our intrinsic value. This is what we would refer to as the real value. This $1.60 that is left over right here, which is the remainder of the price of the option, this is all extrinsic value. But extrinsic value is made up of two things: time and hype. Now, is hype a real technical word? Maybe not. It's the word I'm going to use. Extrinsic value is a combination of the time value, and the technical term for hype is implied volatility. Okay, that's what the technical term for hype is. It's easier for me to describe it as hype. I'll tell you why. Okay. Mary Lou, I'm going to use your example. Mary Lou just gave me an example. I'm going to use that because that's really good. I like that. Okay. That's a great example, in fact. All right. Time is the easier one to figure out. If we're dealing with an option that doesn't expire until the third Friday of January 2019, okay, that's what the option chain would look like, only the A would look a lot better than my A. That looks almost like a Q. Okay, if we were looking at an option that expired in January 2019, and let's say hypothetically it was this price and it was $2 in the money, a large portion of this $1.60, probably the bulk of that $1.60, would be time, because it's a long ways from now until the time that expires. Whatever is left is the implied volatility. Okay, that's the easiest way to remember it. Now there's Greeks. We're in the next class. The reason this working with options class is a part 1 and a part 2 is because there's so much information to cover. In the next class, we're going to talk a little bit about the Greeks. We're going to talk about deltas and gamma and theta decay and the vega, and we're going to talk a little bit about this. But there are formulas that exist that help you understand the time value and the implied volatility of the extrinsic value. So if we took our extrinsic value, we're going to say this is made up of time and implied volatility. The reason I call implied volatility hype is because it'll be higher when there's a lot of excitement generated around something to do with that company or that stock. If it's low, there might not be a lot going on. A great example is right before the release of the next iPhone, I promise you the implied volatility is going to be a little bit higher for Apple stock. And it's going to be reflective in all the different options. There's going to be a little more implied volatility because there's a little more excitement, a little more hype about how well is this new iPhone going to do? What's it going to have that the old one doesn't? What's it going to look like? How many new accessories am I going to have to buy because none of the old ones fit the new one? Okay, that's a good example of implied volatility. As an analogy, Mary Lou said, think about if you had a mug of beer, and for those of you that don't drink alcohol, a soda pop will work just fine. There's the actual level that you pour the beer to, and then there's the foam on top of it. This is your extrinsic value. This is your implied volatility. It'll eventually fizzle down and just be the actual liquid. It'll eventually go to that. But when you pour it, and think about this, I don't know if she even meant this as part of the analogy, but when you're pouring it, the excitement is a little bit higher and it's foaming up a little bit higher, and that's more implied volatility and less time. in that extrinsic value. Okay, for some of you, this is a completely foreign language. As we go through more and more and more, this will make more sense to you. All right, let's move back to where we were. The in the money options, remember how we talked about these being highlighted? Let's talk about the out of the money options first. Okay, I'm sorry, I forgot that first we're going to talk about out of the money options and then in the money options. A call is out of the money, a call option. So in this case, our strike prices are the 155, the 160, 165, 170, etc. If the strike price of the option is higher than the current price of the stock, then a call is out of the money. And what that means is that whether you're looking at the bid price or the ask price, doesn't matter. I circled those in reverse order, sorry. Whether you're looking at the bid price or the ask price, these are 100%. All of this, every penny of that $6.95 or $7.40 is extrinsic value. There is zero intrinsic value in these out of the money options. On the put side, if your strike price is lower than the price of the stock, you're out of the money. And that means none of these prices over here, doesn't matter if it's bid price or ask price, none of these have a single penny of intrinsic value. They are made up 100% of extrinsic value. And some portion of this is the time, and some portion of this is the implied volatility. Okay? Simple. If a money is out of the, if an option is out of the money, on the call side, it's higher than, the strike price is higher than the current price of the stock. On the put side, it's lower. That's what out of the money option is. If an option is out of the money, it has no intrinsic value. 100% extrinsic value. Okay, there's the prices that are in the money, out of the money. This 165 long call is out of the money because this is where the stock is currently trading. In between the 150 and 155, I know I've covered those with my stuff here. There's the break off between the option strike prices that are in the money and out of the money. Now on the put side, this one is in the money. On the call side, it's out of the money, and vice versa. Okay? Oh, the reason that last one came on, sorry. This indicates that we're even farther out of the money. The higher the strike price, the farther it's getting away from the current price of the stock. On the call side, the farther out of the money it is. The lower the strike price, the lower the strike on the put side, the lower the strike price, the farther away it gets from the price the stock is actually trading, the farther out of the money it is. Okay? In the money options. These are the ones that are oftentimes on most brokers' website, these are going to be highlighted. In this case, you can see that's the section that's highlighted in light blue. That means they're in the money. And what that means also is that these option prices have some, at least some intrinsic value. This option is barely in the money. This is a little bit, now we're looking at the call side. A little bit deeper in the money, a little bit deeper in the money, a little bit deeper in the money. This option is just barely in the money. This one is on the put side. This one is a little deeper in the money, a little deeper in the money, a little deeper in the money. Okay, the farther, if we're in the money, the farther we go from the strike price, or excuse me, from the current price, the farther the strike price gets from the current price of the option, the deeper it's in the money if we're going in that direction. Okay, 130 is deep in the money on the call side. There's the break off between which options are in the money and which options are out of the money. Now, quick little exercise. Let's do a quick exercise here. And let's choose the 140 strike on the call side. 140 strike on the call side. Think back to the analogy I did and the example I gave, or the example Mary Lou came up with the mug of beer or the glass that you're pouring your soda pop into, whatever carbonated beverage you have. If the stock is currently trading at 152.16 and we're looking at the 140 strike call, how much, and let's just go, let's stick with the ask price of $16.20, okay? So we're going to stay with $16.20. How much of this $16.20, here's a little exercise for you. How much of that 1620 is intrinsic value and how much of it is extrinsic value? And don't worry about the extrinsic value, what portion of it is implied volatility and what portion of it is time. Think strictly in terms of $16.20. How much is intrinsic and how much is extrinsic value? And let's see, I'm not going to call anybody out by name, but let's see how many of you come up with the right answer. The stock is currently trading. Let me give you a hint. Start out with the 140 strike price and subtract from that the 152.16 that the stock is currently trading at. There's your big, huge, giant hint. Okay, take this 140 strike price and subtract from that the price the stock is currently trading at. Or you can go the other direction. Since this is higher, you could go the other direction if you wanted to. You could say 152.16. If you don't want to deal with negative numbers, 152.16 minus your 140 strike price. You come up with the same digits, you just either have a plus sign or a minus sign in them. Okay. All right. Here's what you come up with. The difference between them came out to $12.16. That is your intrinsic value. Okay? $12.16 is your intrinsic value. The difference between where the stock is trading and your strike price is your intrinsic value. Whatever is left in this is your extrinsic value. So if we now take 1620 and we subtract 12.16 from it, we now have $4.04. Okay, of this $16.20, $12.16 is intrinsic value, $4.04 is extrinsic value. And it doesn't matter how much of this is time value and how much of it is implied volatility, at least for right now. We just know that $4.04 of that option price is extrinsic value. $12.16 is intrinsic value. We need to keep moving along so that we don't run out of time here. Now, I told you when we got to the end of the presentation, we'd have some other option chains. I didn't have time to switch these out. Okay, but as another exercise, and you can see these are old options. These are from back in 2016. Okay, if the stock is currently trading at $70.71 and we're working with the 67.50 option at $7.20, I'm just giving you another example of how we came to those numbers we did on the other page. 70.71 minus 67.50 is 321. That is our intrinsic value. Our total price of the option, 720, minus our intrinsic value is our extrinsic value. Easy to figure out. Now, last thing, this is where we're going to end this class with, and then when we go into the part 2 of working with options, we're going to get into more stuff and make this even more fun. Let's talk about open interest. When you're looking at an option chain, whether it's calls or puts, you're going to see columns that indicate open interest and volume. Okay, this is important to know this. Open interest is a current snapshot of how many buy orders currently exist. Now, you know, for an order to fill, there has to be a sell order that goes with the buy order, right? You know, if there's a sell order for something, there has to be a buy order in order to get filled. If I want to buy the 85 strike long call on Facebook, there has to be someone willing to sell it to me. This number in open interest is a reflection of the current buy orders that exist. People have put in orders. Of these 736 buy orders, only 50 have sold or have been filled. There have only been 50 sellers to match up those 736 buyers. Open interest, whether it's on the call side or the put side, is irrelevant. Open interest is a reflection of how many people currently want to buy this particular strike price option at this particular expiration date. We're exactly 1 year back on this one. And volume is an indication of how many sellers there were such that the brokers could actually fill those orders. In the next class, we're going to talk more about why that is so important. Okay, but understand, open interest means there are people interested, just like the word implies. There's people out there that are interested in buying, but there's a lot less people interested in selling. Okay, keep that in mind. We'll talk more about that in future classes. Folks, I don't have a summary for working with options part 1 because we're going to pick up where we left off and go into working with options part 2 in the next class. And we'll get into some information about the Greeks. We'll get into information about limit orders, limit credits, limit debits, how to open an option, how to close an option, and so forth. And by the time we start diving into the actual strategies, hopefully you'll be an expert at understanding the option chains and knowing how to use them. Thank you for your participation. That's where we're going to wrap up, and we'll see you in the next class. Bye-bye.